Net worth versus investable assets. That's the topic that we're going to discuss today. Elliot, I am sort of embarrassed to admit that this is something that I struggled to really fully wrap my head around during the first several years of pursuing financial independence. So I'm thinking that there's maybe other people out there that still don't fully understand the difference between these concepts, and maybe they hang their hat on their FI number when they're looking at and using just their net worth to determine that.
Yeah, totally fair. I mean, I don't know what a liquid asset is.
Oh, come
So
on.
it's got to be Magic the Gathering cards, right? Those are liquid assets.
Yeah, yeah,
Yeah.
absolutely.
Yeah.
I guess we'll define a couple of terms here real quick. At least I'll share with you what these terms mean to me. You can tell me if I'm right or wrong, or if you'd add or subtract anything from this information. So net worth, I started tracking my net worth in 2012, and I think it was around the time that I was watching, or I should say, I was reading the blogs of like Budgets Are Sexy and even Carl, Mr. 1500. They were they were sharing their net worths online. And so I started tracking mine around the same time. And when I learned about financial independence and pursuing that, I thought that I was going to be using my net worth to determine whether or not I was financially independent. So, net worth, at least in simplest terms, the way I can describe it is all of your assets minus all of your liabilities. So, it's what you own versus what you owe. Would you add anything to that?
No, I think that's a great definition.
It's succinct. We agree on something. That's great.
Yeah. Hey, check
Rough.
one for the day. I don't know if we're going to get any more, but at least we got one.
Yeah. The investable assets part of it is the area that I feel like it was a bit of a blind spot for me because I was just tracking net worth and I was rolling everything, all the assets up to that. And then it wasn't until a few years later that I really understood that investable assets is a component of net worth, meaning they're your invested funds, the things that are more liquid, the ways that you're going to actually draw from to support your retirement or any other things that you want to support. You're going to be able to withdraw that money directly from those accounts. And these are things like your 401k, your Roth IRA, your brokerage account, any number of different holdings of that money. Those are more quote unquote liquid. Some of them are more liquid than others, but am I on the right track with investable assets?
Yeah. So I would say the terminology that I generally use, and I guess my good buddy Projection Lab uses is liquid net worth. So trying to say, well, for myself, the major distinction between my net worth and my liquid net worth is assets like my house, or maybe you count your cars as assets. I know some people put that into their net worth, some people do not. So in the truest form of a net worth, you would have every single asset and every detractor from that as well, which,
Liability.
yes, thank you. Every liability on the other side of the ledger that you would net out to create that net worth. But overall, that liquid net worth, like you said, is really more, how are you going to draw off those different assets? Like if I know we were talking to our friend Alan this weekend, and we were saying, the variance in house prices as it's changed over let's just say the last 5 years. And what's important to note about that is, yeah, hey, your house, let's say, doubled in value because of cuckoo bananas, COVID prices, and appreciation and everything else, right? That's all well and great, but unless you actually sell the asset and realize the gain, doesn't really make a lick worth the difference. So I think that's what's important when we make the distinction of what's a liquid asset, seeing, yeah, hey, your brokerage, all of a sudden there's a news headline that causes the stock market to jump 4% or drop 20%. Like that is a very measurable difference of how that is going to measure how much money that you're pulling off, even just off of dividends or any gains off of, I mean, theoretically you don't have to do anything. That's going to materially affect how much money that you are returning year over year.
Yeah, I remember very early on as I was tracking my net worth, and I was you back then we used or saw the example of living on $40,000 a year. You needed $1 million of net worth, $1 million of assets. I feel like there was some areas within the space that was still referring to it as net worth, like $1 million net worth translated to $40,000 in what you could pull from a 4% roll. And maybe I just didn't fully understand that there was nuance associated with that net worth, but I feel like it was to some extent thrown around enough that it was kind of like, hey, all you need to do is achieve this $1 million net worth. And as I was tracking it, I'm like, oh, my house price is this and my cars are that. And then at some point the light bulb went off and I'm like, well, with I can't draw down from my personal residence, and I'm not going to sell my car. And so, that really changed and even sometimes I'll notice that as, we're talking to each other, I know whenever I've said, hey, Elliot, here's where I currently stand. And you're like, oh, well, that's what your net worth is. And I'm like, oh, well, no, Elliot, we got to make sure that, because there's like the other example that I'll use is that my, real estate is, so if, just to take it another step further, this example, if we look at your real estate equity, it's there's not really like a safe withdrawal number associated with that. That can be all over the place. And just because we say our net worth associated with both the liquid side of things and then the assets that we have, we can't count those the same. So if I was to, let's say we had $1 million in investable assets and then we had $1 million in real estate equity, you could you could say that you could pull 4% from that $1 million in investable assets and get $40,000 a year in living expenses that you could turn into cash flow that you could use as living expenses. But if you had $1 million in real estate equity, you might not be in a great shape to be able to pull $40,000 from that in cash flow. And that could be because, something like your real estate has appreciated faster than your rents have gone up, or you are in a situation where you have older buildings like I do that you're constantly pouring more money into to keep them functioning properly, and you haven't realized that steady cash flow. So that's where something that I've found that again, I struggled with early on to like say, well, I'm going in two different directions here. I'm investing in all of these accounts. I'm also investing in real estate. How do I bring this together to say with some level of certainty that I can reasonably achieve that withdrawal rate or that level of earnings for a period of time?
Sure. So first off, I didn't know we were turning this into the Josh therapy session. I can sit here and talk about your real estate holdings. No,
Ah,
all kidding aside, yeah, of course is the theory behind what real estate, like you said, is that the cash flow that you are pulling off of your real estate holdings is reducing how much you have to draw from those liquid assets, and hopefully based off of the amount of equity that you have in those assets, that you're getting an equal or outsized return. And quite frankly, I would say an outsized return compared to the market, because otherwise you can press the easy button that I'm pressing over here and just say, yeah, my buddy VTI just does all the hard work for me. So I'm not saying sell all your real estate, but it makes it more complex that you obviously have to do the calculus around all of that. And to your point of whether or not, yeah, rent has kept up with appreciation, or like you said, you have large capital expenditures that change your profit that you're bringing home. There's just a lot of dimensions that you have to take into account holding real estate that don't necessarily show up in a true liquid asset like an equity holding or treasury bills or anything else like that. Now, the other part of that is, right, of course, and I would say that most people real estate would say, yeah, but now I can take leverage against an asset. I know where I am investing. I generally am receiving outsized returns compared to the market. So essentially I'm putting a hedge on I'm making an educated bet. I'm making a hedge against a certain return, and I'm okay with the small amount of pain that it gives me on the other side for the outsized return that I'm receiving. So
Yeah. And to continue your comment about Josh's therapy session here, so something that I've been really struggling with wrapping my head around for the last several months now is in my real estate portfolio, we're not realizing a significant amount of cash flow at the moment. And we've got one property that's vacant, another property that had some significant repairs. We did some capital expense work in late 2025. So it's been just a continuous cycle of pumping more money. The business is paying for itself. We're not paying for this stuff out of our own pockets or anything like that. We're just not realizing the amount of cash flow that we would like to. So I went through sort of a journey early this year over many months where I was like, man, I got to do something different. I got to get rid of these. The whole nine yards, like trying to come up with the best strategy. And here lately, I've kind of come to realize that I've acquired these properties over like the last 10 years. I started in 2016, acquired approximately one a year. I now have eight, but they all had their own level of deferred maintenance and deferred CapEx. And so and I bought them all really cheap, because of that, well below market value. So I've determined that I've kind of changed my mindset somewhat in recent weeks where I'm like, well, you think back to like, Chad Carson uses the analogy of like the fruit tree, where you plant a fruit tree and you're not going to get that fruit from it for many years to come. It's got to grow, you got to prune it, you got to water it, you got to take care of it. It's going to do all those things and it's going to take several years. So I'm I'm kind of thinking along those terms a little bit more with the real estate now, where for instance, the property that I'm currently renovating, I had a conversation with Lori and I said, rather than just get this like rent ready, so to speak, and get another tenant in there, let's like spend the time to do some of this like big CapEx stuff, like rewire the electric because it's the old knob and tube stuff, and then I don't have to worry about it potentially for the rest of my life. And let's do that now as opposed to just trying to get by. So I'm like investing back into these properties in hopes that with this strategy they will pay dividends that are greater than what they're paying now in the next 5 years or so. And that grin on your face is like you're a fool.
No, no, no. I mean, I get your thought pattern. I guess my initial question is always, okay, is your renter going to care whether they have knob and tube wiring or fuses? And are you going to be able to see that in translated rent that you're receiving, essentially?
No, that's a good point. I mean, I think that it's from not necessarily from the aspect of being able to have better and greater rent. It's just the opportunity to fix the known, quote unquote, known issues, because there has been some very minor issues with the electric there that could have potentially led to catastrophic outcomes. There was an outlet that was like melted, and it was because there was a space heater attached to it. And I know that, I mean, amperage and all the other things associated with that. The space heater shouldn't have been plugged in there, but also it should have tripped rather than let it just like melt the outlet. But it could have
Hmm.
caused a fire
Yeah.
that may or may not have been able to be put out. And so, yeah, all that to say, we've really gone off the
What were we talking about,
off the
Josh? No.
rails. Yeah.
No.
But yeah, going back to that, I think that it took me a while to like really be able to see that investable assets can be used to give you like essentially like a baseline. Like if you want to have a baseline of $40,000, you need $1 million in investable assets. I mean, I think we all pretty much agree on that. We could argue whether it's a 4% rule, 5%, whatever. But then where I always struggled to really wrap my head around like what can my real estate portfolio like over time reasonably or predictably throw off in the form of cash flow. And so that is like above and beyond that baseline. And so it's just looking at it from like two different levels of perspective when it comes to like how much money you're able to realize in a given year. And it hasn't been as straightforward as like a portfolio that's essentially all equities.
Yep. I agree. Now, I mean, to the same point that I would say, as far as I have looked at our projections quite a bit recently, you're well aware of this. In the same vein that you thought about net worth, I had the same thought pattern of, hey, this net worth includes my primary residence. I never intend to sell this residence as part of it's not going to generate output. Like I still have to live somewhere. So why should that be included in the 4% rule for me to, say how much money that I need to retire with to for that to fund my family's lifestyle until for as long as we need it to, right? And so for the longest time, my projections have used net worth times 25 was how I was defining financial independence. I will say is that is a very different calculus than just net worth times 25. And actually as of recently I've started to go back and look at just using net worth times 25 and still not even like in projection lab there's the ability to just turn on the flag to say, yeah, hey, if the plan necessitates it, do you actually sell the asset of the house? And I've never turned that on. But even just going from liquid net worth back to net worth, I mean, that's years of working time of a difference. And materially what changes is instead of retiring with tens of millions of, I mean, multiples of tens of millions of dollars, it's like, okay, now maybe I only retire with a couple of $1 million or whatever it is. I mean, and you're talking about a very, very long time horizon. So we all know how compound interest works is that any number with a long enough horizon is going to be a large number. But yeah, you got to be very aware of some of these nuances and like the layers of conservatism that you're putting into all of these numbers. So
I I would thought of something that like kind of clicked for me after I was talking to you. You were showing me your numbers and like the long term range of like end of life, so to speak, what it looked like for you. And I was like, wow, my numbers never have looked that big for me. And then it dawned on me after we had the conversation. I'm like, well, shoot, that's because Elliot's 10 years younger than me. And that last 10 years, I mean, it like, what is it, potentially every 7 years that it's going to
yeah,
double.
like yep.
So you're going to like double in half because you're, t- I'm 10 years already further down the line.
Sorry, Betty. Yeah, I did
Yeah.
just find it a decade in front.
Hmm.
Yes.
But yeah, I don't, I think one of the, I don't know how much more we can spend talking about this, but I've come to realize, I think, over especially the recent months as I've entered into early retirement, and now it's like, okay, well, what do we really, can we really rely on, I guess, with some level of certainty? And for me, like net worth isn't nearly as important as I've spent all these years tracking net worth. And it wasn't really until recently, I think about the last year or so, that I started looking at it, like breaking it out and going, okay, here's my investable assets, here's my quote unquote retirement portfolio.
Right.
And yeah, that number is significantly less than the overall net worth and maybe a little bit more important.
I mean, I'll play a bit of the devil's advocate there, right? You do have a significant real estate portfolio, and so I agree if you're going to basically just look at your cash flow and not look at the equity of your real estate holdings, sure, that's going to change the calculus of it quite a bit. But I imagine probably at some point you will sell. And if you don't, that's fine. But then if you don't, I would encourage you to make sure that you're getting market rates on all of your houses so that you are keeping up with the reason why you're in that asset. And of course, it is giving you, once again, a hedge against, more stability, acting like a bond would in an allocation of your overall portfolio allocation. But by and large, I mean, I think what is important here is just understanding. I mean, I think what you're identifying that has been even more important as of late is understanding that drawdown and how when you move to a decumulation state or you're ready to move to that decumulation state, what are the mechanics that actually looks like? And I know that you and I have talked about this quite a bit, is that everybody talks about accumulation, and it's pretty easy to understand initially. Once you get there, is like that's what gets everybody so jazzed up and excited, is oh yeah, like I can make some intentional tweaks, and that turns into a very real difference. And seeing that number just go up and up and up is great. But then when you have to flip the switch and make it go down, 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 not only the mental side of doing that, but then how do I do this in what kind of assets should we have? When we talked about that a couple of episodes ago about, asset type, and then where should those assets be located in order to make them, let's say, most tax efficient or whatever else. If I want to just say, let's use that $1 million net worth, $40,000. Where am I going to get that $40,000 from? Am I getting $20,000 in cash flow from my real estate, and now I'm getting 10,000 from my Roth IRA, and I'm getting 5,000 from my brokerage. I'm getting 2,500 from, this part-time job that I'm, whatever. I make a little money doing woodworking. Okay. And now you're much closer to actually understanding, well, how do I actually pay for my life in this new phase of life? So we're all smart people to get to the level of, we've accumulated all this money, but now you've got a new problem.
Yep. Josh therapy session. That's why I love having these conversations with you, Elliot. Yeah.
No,
It,
it's probably more me than anybody else.
but it is, you're right. I mean, along the journey and even after, you continue to learn, and it's an ongoing process of figuring out how all these pieces fit together. And just when you think you got a handle on all of it, it's like there's some new bit of information, or you're having a eye-opening revelation that, oh yeah, well this affects that, you know, and there's trade-offs with everything that you essentially learn on the other side of it that, you know, I didn't necessarily learn everything that I needed to learn when it came to withdrawal strategy. And we're not there yet, but as we eventually approach that, that's the stage that I'm in my financial independence journey, is learning all of that, like what makes the most sense. And even I was going to mention earlier at the top of the show, I threw out that thought experiment a couple episodes ago on the 401k withdrawal. And, you know, that being the very unoptimized way to get at some of your money by paying some penalties. But I've actually had a lot of feedback on that, and not to say that anybody is necessarily in agreement with that, but I have had some folks, even our own buddy Allen, he's like, I've thought about that more, and you know, here's some couple of things to think about, and he's kind of come around to like, I understand the situation that you're in, and how here's how I would maybe go about it, knowing, you know, like you don't want to take on more debt, or you don't want to totally draw down your cash position that you're in. So, yeah, all that to say, like it's great to have these conversations and continue to have these thought experiments and really talk through these things, and hopefully us talking through them is in some way helpful for other people. I know they're helpful for me.
Yeah. No, and that's exactly the same way that I feel. Is half the time it's just my babbling, incoherent thoughts that allow me to make some semblance of a decision of which I'm struggling with in my own mind to, as Brad and Jonathan would say, you got to take action, right? So you can listen to a podcast all day, but unless you actually make a meaningful change, doesn't do a lick of good.
Yeah, and
So,
it's funny that we can look at each other's situations and be like, "Oh yeah, if I was in your shoes, I would do this." But then, you know, like I feel like in a way we're maybe more aggressive with each other's circumstances or
oh yeah,
portfolios than
for
we
sure,
are with our own.
absolutely. You everybody is each other's best critic, or I don't know.
Armchair quarterback.
Yes, armchair quarterback. That's a better way of putting it. So,
Yeah.
all right. Well, do we have anything else on this one?
I don't think so. This was a short one, but I think
Yep.
it was good for me.
Good for me as well. All right. Until next time.
Yep. Talk to you later.
See ya.